In a world of dizzying market swings, where fortunes can vanish overnight, where do investors turn for safety? For thousands of years, the answer has been the same: a gleaming yellow metal. Today on Fun Facts Online, we're digging into the crucible of chaos to understand why gold remains the ultimate safe haven in turbulent markets. Gold's story is as old as civilization itself. Ancient Egyptians revered it, pharaohs were buried in it, and it formed the bedrock of the very first coin systems. The rise and fall of the Roman Empire was directly tied to its gold reserves. This isn't just a romantic footnote in a history book. It's the very foundation of gold's role as a financial sanctuary. This millennia-long track record as a trusted store of value has embedded a deep-seated confidence in gold within our collective psyche, a trust that resurfaces with a vengeance whenever financial storms gather. The 20th century formalized this role with the gold standard, a system where a country's currency was directly linked to a specific quantity of gold. But, paradoxically, when the United States abandoned the gold standard in the early 1970s, it may have actually enhanced gold's safe haven status. Freed from its fixed peg to the US dollar, gold's price could now float freely, allowing it to react to and absorb global economic anxieties. And it did. The 1970s were hit by stagflation, a toxic cocktail of high inflation and stagnant economic growth. As the purchasing power of paper currencies eroded, the price of gold soared from just $35 an ounce to a staggering $850 by 1980. This cemented its reputation as a powerful hedge against inflation. So what is it, exactly, that makes gold glitter in the eyes of nervous investors? What's the anatomy of this ultimate safe haven? First, it's about its intrinsic and perceived value. Gold's value starts with its physical properties. It's incredibly rare. In fact, all the gold ever mined is estimated to fit into a single cube with sides of about 22 meters. It's also durable, it doesn't corrode, and it has real-world applications in jewelry, electronics, and even dentistry. This gives it a baseline of tangible worth, unlike paper assets whose value is based on a promise to pay. A significant portion of its value, however, is monetary, derived from its global role as a financial backstop. Second, as we saw with the 1970s, it's a legendary hedge against inflation and currency devaluation. When central banks increase the money supply and the value of our everyday currency declines, gold has historically tended to appreciate, preserving purchasing power. Because gold is priced in US dollars, when the dollar weakens, it takes more of those weaker dollars to buy an ounce of gold, pushing its price up. Third, and this is a crucial point, physical gold carries no counterparty risk. A stock's value depends on the performance of a company. A bond's value hinges on the issuer's ability to pay back its debt. A bar of physical gold, however, is an asset whose value is independent of any single institution's solvency. Its value doesn't depend on a promise from anyone. This makes it an invaluable asset in times of systemic financial risk, when you're worried about banks or even governments failing. Fourth, gold often acts as a fear gauge. Its price tends to rise in response to geopolitical instability, trade wars, or political turmoil. When investor confidence in traditional markets fades due to these external shocks, they flock to gold to shield their assets from unpredictable swings. Finally, gold offers diversification. It often has a low or even negative correlation with other major assets like stocks and bonds. This means its price tends to move independently, or even in the opposite direction, especially during a market downturn. Including gold in a portfolio can therefore reduce overall risk and provide a buffer against losses in your other investments. The true test of any safe haven is how it performs during an actual crisis. So let's put gold to the test with some modern examples. Remember the 2008 global financial crisis? The collapse of Lehman Brothers sent shockwaves through the entire system. Stock markets plummeted. The S&P 500, a key benchmark for US stocks, fell by a catastrophic 38%. And gold? It surged by 25%. Over the 5-year period that encompassed the crisis, From 2008 to 2012, gold nearly doubled in value, rallying from around $825 to more than $1.650 per ounce. Investors, businesses, and even central banks piled into gold as a hedge against systemic risk. Let's fast forward to the COVID-19 pandemic in 2020. This was an unprecedented global health and economic crisis. While gold did see a brief dip in March 2020 as investors scrambled for cash, it quickly rebounded. Fueled by safe haven demand and massive government stimulus packages, the price of gold surged, hitting a new all-time high of over $2,000 an ounce in August of that year. In a year when global stocks faced extreme volatility, gold posted a gain of nearly 24%, and this trend continues. The years since the pandemic have been marked by rising geopolitical tensions and a global surge in inflation. These factors have once again brought gold to the forefront. Central banks around the world, particularly those looking to diversify away from the US dollar, have been accumulating gold at a record pace. This institutional demand, coupled with investor anxiety, has provided strong support for the gold price. So for an investor convinced of gold's merits, how do you add it to your portfolio? There are several ways. The most traditional method is buying physical gold, like bars or coins, such as the American Eagle or Canadian Maple Leaf. This offers the ultimate security of a tangible asset with no counterparty risk. However, it comes with challenges like secure storage, insurance, and it might not be as easy to sell quickly as other investments. A much more popular and convenient route today is through gold exchange-traded funds, or ETFs. These funds, like the SPDR Gold shares, hold physical gold in vaults, and investors can buy and sell shares of the fund on a stock exchange, just like a stock in Apple or Tesla. ETFs offer high liquidity and low transaction costs, but do come with management fees. For those with a higher risk tolerance, you could invest in gold mining stocks. If the price of gold rises, the profitability and stock price of a mining company can rise even faster. But this is a leveraged bet that carries additional risks, like poor management, operational problems, or political instability where the mines are located. And in a nod to our digital age, there are now even gold-backed cryptocurrencies. These are digital tokens that aim to combine the traditional stability of gold with the technological advantages of digital assets, like easy transferability. Now, it's not all a golden story. Gold is not without its critics, and it's important to understand the counterarguments. The famed investor Warren Buffett has famously derided gold, comparing it to a pet rock that doesn't do anything but sit there and look at you. The primary argument against gold as an investment is that it produces no yield. Unlike stocks that can pay dividends or bonds that generate interest, gold produces no income. This can be a significant drawback, especially when interest rates are rising and other assets become more attractive for the income they provide. And while it's considered a safe haven, the price of gold can be volatile in the short term. Its price is influenced by a multitude of factors, including pure investor sentiment, which can lead to big swings. Finally, there's the opportunity cost. Holding gold means foregoing the potential for growth in other asset classes like equities, which have historically delivered higher returns over the long run. So what is the golden balance? What is the appropriate role for gold in a modern portfolio? Most financial advisors don't recommend an all-or-nothing approach. Instead, they view gold as a form of portfolio insurance. A strategic allocation to gold, typically in the range of 5 to 10% of a portfolio, can help to mitigate risk and provide a cushion during periods of market stress. The goal of this allocation is not necessarily to generate spectacular returns, but to provide stability and diversification. Think of it as a parachute for your portfolio. You hope you never have to use it, but you're extremely glad it's there if you do. In a world of increasing complexity and uncertainty, gold's ancient appeal has not waned. Billionaire investor Ray Dalio has noted that gold is the currency least likely to be devalued or confiscated, having maintained its value for millennia. As investors navigate the volatile markets of the 21st century, the timeless wisdom of turning to gold in times of trouble remains as relevant as ever. It is not just a relic of a bygone era, but a vital component of a resilient investment strategy, a golden constant in an ever-changing financial world.